Good afternoon, everyone. Welcome to the Foreign Correspondents Club of Japan here in Tokyo. I'm Anthony Rowley. I'm a former president, and I'll be moderating today. And it's my pleasure to welcome our guest speaker, on my right, of course, who is Albert Park, who's Chief Economist and Chief Spokesperson on Economic Issues for the Asian Development Bank, or ADB, in Manila. He's going to be talking about the many challenges that obviously are facing the Asia region at the present time, and they range from the ongoing COVID pandemic to fallout from the war in Ukraine, and unfortunately many other challenges too. Okay, well, time is fairly short, so I'll just say a little more about Mr. Park's background before handing over to him. He is, as I said, the Chief Economist and Chief Spokesperson for the ADB on Economic Issues, a position which he took over or assumed in December of last year. As such, he leads the Economic Research and Regional Cooperation Department of the ADB, which publishes key knowledge products such as the Asian Development Outlook, the Asian Economic Integration Report, the Asian Bond Monitor, and key indicators for Asia and the Pacific. Our speaker has more than 2 decades of experience as a development economist. He's an established expert on China's economy, and he's directed numerous large-scale research projects in China. He's also served as an international consultant for the World Bank, and he's a member of the steering committee for the Asia-Pacific Research University's Population Aging Hub. He's worked on a broad range of development issues, including poverty and inequality, intergenerational mobility, microfinance, migration, and labour markets, and the future of work and foreign investment. And on top of all that, he's Chair Professor of Economics. He's on leave at present at the Hong Kong University of Science and Technology, or the HKUST, and he previously served as Director of the Centre for Economic Policy at the HKUST. He also served as a founding director of HKUST's Institute for Emerging Market Studies. And as if that wasn't enough, he was a professor of economics at the University of Oxford too, and also an associate professor at the University of Michigan. He's national of the United States. He received his bachelor's degree in economics from Harvard University and his doctorate in applied economics from Stanford University. So with that brief introduction, I'm going to hand over the floor to Mr. Park. Usual point, please, if you have a mobile phone, please switch it off or put it on manner mode as a courtesy to our guest. So, Mr. Park, please.
Thank you very much, and it's a pleasure to be here. At the ADB Research Department, we have a macroeconomics research division that spends quite a lot of time monitoring the global economic situation in Asia and in all of ADB's member countries. And there has never been more demand for our views on the outlook because things have been changing so much this year with so many new challenges. So it's a great honor to be here to share some of our thinking about how Asia needs to navigate all of these headwinds. Every year, we issue an Asian Development Outlook report in April. This year's April report projected that regional growth in developing Asia would be 5.2% this year and 5.3% next year. And inflation was projected at 3.7% this year and 3.1% next year. Since then, the situation globally has changed. And in our updated estimates, which we release quarterly, there will be one released very soon. These numbers are all going to be adjusted downward because many of the headwinds to growth have strengthened. One of the major impacts has been the economic slowdown in China, in the People's Republic of China, which has been the product primarily of very strict lockdown measures in various cities to control COVID outbreaks. And that has also impacted the Japanese economy with supply chain issues arising from shutdowns in Shanghai, for instance. We all know that the Russian invasion of Ukraine has been another global economic shock, which has heightened uncertainty and unsettled commodity markets. So we now have a lot of discussion about a potential energy crisis. In fact, we see very elevated oil prices. Today it's sitting just near $100 a barrel. And also great concern about a potential food crisis globally due to higher food prices and fertilizer prices. At the same time, we see aggressive tightening by the US Federal Reserve, which historically, and in this episode as well, is raising concerns about financial instability in other parts of the world, especially in emerging markets. We see market declines, rising spreads, evidence of capital outflows and depreciations in many of the countries in Asia, including Japan, where we've seen a market depreciation of the currency. And the most vulnerable countries in Asia have really been hit hard, and obviously the most notable case is Sri Lanka. But of course there's concern that if growth continues to be slow, if interest rates rise, and if there's an even worse shock, like a global recession, that this could push other countries kind of over the edge into greater financial instability. We also see evidence of scarring effects of the pandemic, learning losses, high youth unemployment, which will affect future productivity if they're not addressed in a fairly urgent and direct fashion, and those carry risks for medium and longer term growth. So let me go through some of these headwinds in a little bit more detail in my opening remarks. So first, just to set the stage, what was performance last year? Last year was a pretty robust growth year, a bounce back year for Asia. So in developing Asia, growth was 6.9%. And you can see on the figure on the left that there was regional differences with particularly strong growth in South Asia, coming back from a very negative shock in the first COVID year. Strong recovery in East Asia, led by China, and as well in Caucasus and Central Asia, but somewhat more moderate recovery in Southeast Asia, which was hit a little bit harder by the Delta variant, COVID, and a slower kind of labor market recovery. And in the Pacific, we see that their recovery hasn't really begun yet because they've been hit so hard by tourism shocks due to the lack of international mobility. What has been very robust in Asia has been the recovery of exports. So in the right-hand side, you can see that, especially if you look at the gray line for developing Asia, excluding China, China, of course, had a very quick recovery because they dealt with the virus so effectively initially. But for the rest of developing Asia, you see this very steady growth in exports starting in the second half of 2020, really through the end of last year. And this has really helped drive recovery in the region. So these are the most recent forecasts that we've released for growth in developing Asia, and it's broken down also by subregions. This is the table on the left of this slide. And again, we predicted 5.2% this year, 5.3% next year, and we predicted the most robust recovery in South Asia, with slower recoveries in Caucasus and Central Asia, mainly because of the more direct ties to Russia, and thus hit by the Russian invasion of Ukraine, and a slower recovery in the Pacific. And those regional differences, I think we continue to, are consistent with our current thinking, but overall we see growth slowing down throughout the region. In terms of inflation, if you look at the actual inflation numbers for developing Asia compared to other parts of the world, you can see that inflation has been much lower. And in April, our forecast was 3.7%. That's going to go up given the rise of inflationary pressures globally. But it's still going to predict a level of inflation in Asia, which on average is much lower than other regions of the world. Partly because Food price inflation has not been as bad in Asia. Many countries, the staple is rice, and rice has not seen a big price increase like wheat and corn. But also supply chain bottlenecks have been less severe in Asia as a whole, due perhaps to better logistics or being higher in the global value chains issues. If we look at the effect of the pandemic, which of course continues globally, Asia has really recovered pretty well. You can see that just in terms of the cases on the left-hand figure, the spike in Omicron cases was delayed. It happened later in Asia than it did in the US and in Europe. And also, it didn't peak as high, and it came down very quickly. So part of that is due to success in expanding vaccination coverage in many countries in the region, although there's still a lot of variation across countries. That's in the right-hand figure in this slide. But what this has meant is that governments were able to avoid severe lockdowns of their economy. So this left-hand figure presents an index of government stringency with respect to COVID-related measures. And you can see the stringency has really gone down in this year in the first part of 2022, even despite the spike in Omicron cases. And that reflects an attitude and an ability to cope with the COVID shocks in a way that avoids extreme lockdowns. Of course, China is an exception in terms of how they've approached the Omicron spikes. And in the right-hand figure, you can see, so this is a very full chart of numbers, but these are PMI indices for manufacturing and also for services. On the bottom panel, that's for China and India. PMIs above 50 are expansionary. PMIs below 50 are contractionary. That's all you really need to know. And so the green shaded numbers are ones which are expansionary, and the red are contractionary. And what you can see is that if you look at, since the last quarter of last year and then the first 2 quarters of 2022, we see mainly green everywhere, which means that economies have continued to recover despite the Omicron issues. With one big exception, is China. You can see that PMIs for manufacturing fell below 50 really in January, then again March, April, and May. And even more strikingly, the services PMI for China went all the way down to 42 in March of this year, to 36.2 in April, and 41.4 in May, and those are really low numbers. Those are similar to like at the beginning of the COVID lockdowns in China. And so that's a very sharp decline in service sector activity, which has been the source of the overall slowdown. And you can see that this is a figure that plots the overall consensus forecast for growth in the PRC for 2022. And this is just saying those forecasts are universally being adjusted downward from 5.5%, which was the government's target for the year, to now an average forecast somewhere between 4 and 5%, much less than had been anticipated. And we see in the official data a decline in retail sales and industrial production contracting in April. May, too, we saw continued contraction in retail sales and a very slight moderate recovery in industrial production. But this remains a key challenge because so much of the region's economies are linked to China. We've done, in an earlier study, we had estimated that a percentage point decline in growth in China reduces growth elsewhere in Asia by maybe 0.3%, to give you a sense of how important China is to the rest of the region. Now, of course, the next big shock has been the Russian invasion of Ukraine, the war in Ukraine, and this has led to a huge spike in geopolitical risk, the perceptions of risk, and in terms of commodity prices, the most attention has been to the oil price shock, which spiked to 120-something, peaking, and then has kind of come down and bounced around, but it seems to be very likely to be averaging over 100 for 2022, which is a huge increase from the previous year. We have been very concerned that there could be some even more extreme downside scenarios related to spiking oil prices. So one scenario that we've considered is if there's some escalation in the Ukraine war and the rest of the world, especially Europe and the US, decide that they're going to do an absolute ban on Russian oil imports immediately, which they haven't done yet. It's more of a phased agreement. But if they were to tighten that to be no more Russian, that could lead to a spike in oil prices as high as $200 a barrel, in our view. And so we've run some scenarios about, well, what would happen in this kind of worst-case scenario of a spike to $200 a barrel. And we do three scenarios. One is if there's just an oil price shock and there's no real reaction from monetary authorities, et cetera. And then we do a second scenario where there's that the oil price shock really unhinges inflationary expectations and so requires monetary response in terms of higher interest rates, which are going to slow growth, et cetera. And we do a third worst-case scenario where, in addition to that monetary response and unhinged inflationary expectations, you see a more global depressed sentiment by consumers and investors and more crises, financial crises that kind of feed on themselves. And so in these three scenarios, you can see that if it's just an oil price shock, the shock will be short-lived. But with this most likely scenario of a persistent inflation shock, we would anticipate growth in the region to be lower by about 1.3% this year, and the effects would be lesser next year. And in this financial turmoil scenario, the shock this year would be similar, but then it would continue into next year and be even sharper next year. And these scenarios would also be accompanied by higher inflationary expectations. That's the figures on the right. Now, the higher oil prices have mainly affected Asia through really the price of commodities. Most of Asia doesn't have a lot of direct trade and investment with Russia. So in this figure, you can see the countries that have the highest amount of net exports, they benefit from a higher oil price, and the countries that are net importers with respect to their GDP. And the right-hand side, you can see the effect of the war on other commodity prices. And there was a spike in all these prices, but again, the exception is the rice price, which is this blue line, which has been very stable and actually much lower this year than last year, which has helped stabilize food price inflation, or help limit food price inflation in Asia. And the last slide I want to put up is about learning loss, because we've been doing some special kind of research activity to try to document the extent to which school closures during the pandemic, which have been more prolonged in Asia than in other regions of the world, to what extent this is going to reduce the productivity of workers in the future due to lost education and thus lost lifetime earnings. And we estimate for the whole region that the effect of all of these learning losses could equal about 6% of the workers' lifetime incomes of the kids who were affected by the school closures. And that this would be equivalent to, the lifetime earnings loss would be equivalent to about 13% of regional GDP, so quite substantial. And these figures also document that these effects would be much more severe for poor households, children from poor households, and also will be more severe for girls compared to boys. And so we, despite all of these headwinds, it's important to keep sight of these issues which will affect future productivity of the economies. So just to conclude, government leaders in the region face a very difficult balancing act. You know, on the one point, we still are in the recovery period from COVID, and governments want to support that economic recovery. There's, of course, other goals that governments want to pursue in terms of achieving the Sustainable Development Goals, realizing a green transition, et cetera. But at the same time, there's all of these macroeconomic risks, and because there's been compounded shocks of the pandemic and then the Russian war in Ukraine, invasion in Ukraine, it doesn't provide much fiscal space for many countries to deal with these things, these different concerns. And so each economy and each government is going to have to weigh these trade-offs in light of their specific circumstances to figure out how to kind of balance these different concerns. We also want to emphasize that even while managing these crises, developing Asia must stay focused on sustaining its growth dynamism. And that means staying committed to regional and global economic integration, which creates greater opportunities for everybody. Also to invest in digitalization, green energy transition, and education and worker skills. Another area which we're trying to provide support and advice is to really think about ways to mobilize more tax revenues to increase the fiscal space that governments can use to then address these competing needs. Let me stop there and open it up for questions.
Okay, thank you very much indeed. Very challenging points. Just before I hand over to the questions, I can't resist the temptation to ask you, you mentioned the possibility of oil prices even reaching $200 a barrel. What kind of weighting do you give to that scenario? Is it very unlikely? Is it possibly? What is the weighting you give to that scenario?
It's hard to, of course, give a precise probability to any future event. I think it's quite low, actually, just because I think there is growing concern about the global impacts of the sanctions against Russia. And so there's a lot of pressure to allow the world to adjust gradually, at least in these key energy commodities, rather than create huge stresses on the economies. And many economies who feel that a $200 oil price would really create hardship may be reluctant to go along, right, with a policy of immediate and 100% stopping of oil imports from Russia. So there are a lot of reasons why you would expect this to be an unlikely outcome, but it's a bit unpredictable, right? The course of the war and the response. So I think we just want to be prepared to be thinking about some of the low probability scenarios. And it's certainly not a scenario that you could rule out because, you know, the initial set of sanctions were even more gradual, and then they've been accelerated as there's been more impatience. And as the course of the war shifts, there could be a shift in views about the response that's required. But at this point, we think it's a fairly low probability. And also, even if it spiked to $200, you know, there would be a supply response to such a high oil price. And so it would spike and then start to come down gradually. And by early next year, I think, would come back to more reasonable levels. So it's not like we would see $200 oil prices for months and months. That's really unsustainable.
Okay. Questions from the floor first. Anyone? If not, I have 3 questions online. Take the first one from Andy Sharp with the Nikkei Asian Review. He says, the ADB was adamant that Western-style inflation would not hit Asia. While we are not seeing prices rise as fast as in the West, CPI, Consumer Price Index, is hitting multi-year highs in many places in the region. Would the ADB now readjust that view, especially with the situation in places such as Sri Lanka?
Right. Well, the situation in every country is different. And we are seeing very high inflation in Central Asia, some Central Asian countries, and Sri Lanka, of course. So I don't think we were ever adamant in saying no countries would have high inflation in the region. It depends on many factors in terms of their dependence on oil and food imports, especially wheat imports, and also how well their macroeconomy has been managed. Of course, in Sri Lanka, the macroeconomic management has been relatively poor even before the crisis, which made them vulnerable to what we've seen in terms of the balance of payments crisis. But broadly speaking, I think we're sticking to our guns and saying that the inflation in Asia is much less than in the West. But monetary authorities need to be monitoring the progress of inflation vigilantly. A lot of people thought that if the inflation were really caused by a supply-driven shock to oil, not reflecting a fundamental change in demand or core inflation in terms of rising wages and whatnot, expectations, then monetary authorities really shouldn't react. It's only when inflation, if it stays elevated for a long time and starts to affect expectations broadly among workers and firms and the economy, then it starts to get built into things. And also, if it's high for a long time, especially oil, as an input in production, it can start working itself through to other prices of produced goods. And then you can start to see inflation spreading not just from oil but to other prices, right? And once you see that, it's spreading broadly, then I think monetary authorities really need to jump in and be aggressive to try to keep those inflationary expectations under control. So I think each country is a bit different, and we see some countries have started to respond by increasing interest rates because they fear the inflation risks are getting worrisome. But we see other economies that have been kind of putting greater priority on sustaining recovery. So, for instance, the Philippine Central Bank, I think, came out saying we're going to monitor it, but we don't think inflation is high enough that we want to choke off recovery. And, in Japan, of course, this is an issue as well, whether the government is balancing these things correctly, whether they need to support recovery or whether inflation is getting to the point where they need to adjust. And those are not always easy. The timing, of course, is the key thing, and that relies on a lot of judgment, but it's not an easy thing to manage, but it's what every central bank has to manage in the world we're in.
Okay. We'll come back to Japan later, maybe. Another question here from Yuko Takeo of Bloomberg News. She says, what's your view on the risk that the Federal Reserve's rate hikes will cause a global recession, including the risk that it'll have an outsized impact on Asia? Do you think the Bank of Japan is right in sticking with its low rate stance, and are the markets wrong to bet on normalization from the BOJ? Sorry, we are back to Japan.
We're back to it. Well, I mean, I think the IMF has also said it cannot rule out that a recession, might occur, but that's different than saying a recession is likely to occur. So our growth forecast in terms of what the most likely scenarios are is that recovery will continue in Asia, and also in the Western countries we'll see positive growth, but less than kind of we had forecast earlier. So we're going to bring down our estimates, but that's our most expected scenario. And so again, a recession is less likely, and how likely, is really a matter of opinion. It's very hard to be very precise about that. One thing I would say is that if the U.S. had a recession and it spread to other countries and other countries really went into recession, negative growth, then that would, of course, release pressure on prices to some extent. So maybe inflation would come down and there would be... So those are, I think, a matter of judgment. I think will require just kind of very vigilant monitoring. I don't think you want to completely adjust policy based on a fear about a scenario where the data doesn't seem to indicate that it's really incipient. But you need to be monitoring the situation so that as soon as it seems like it's turning that way, you're not being caught off guard or falling behind the curve on what needs to be done. to adjust. I will not make an assessment of the Bank of Japan's specific policy. I'm not expert enough on the Japanese circumstance, but I'm sure they're trying to do their exercise their best judgment, given the data they have.
Okay, diplomatic answer. All right, another question now from Ilgin Yorulmaz of BBC World, Turkish. She's a freelance. She says, Mr. Park, looking at Sri Lanka's forfeiting of its debts and the chaos that followed its economic problems, do you agree with the opinion that if part of the problem was state corruption, the other part was the country's preference for China over Japan in raising funds and being a victim of China's so-called debt hostage diplomacy that used these governments so conveniently? Which other Asian and African countries are under such a risk currently? So it's a rather long question. Do you want me to repeat it? Or you...
Right. No, I got it. So there's two parts of that, I think. Personally, I don't think the bank or ADB has an official position. I don't think the real issue is that the debt was from China versus Japan, and I don't think there's very strong evidence of the debt diplomacy kind of trap for Sri Lanka being this ultimate cause of everything. And in any case, those were decisions to take on that debt by the Sri Lankan government. So I think we come back either way to the macroeconomic management of the government. And for many years before this crisis, Sri Lanka has been running pretty high government deficits and accumulating debt. And it was because it wasn't able to really resolve these pressures in a way that could generate reserves and reduce the debt levels to prepare itself for a shock. It was at a point that if there was a huge shock, it was very vulnerable, right? And it was very different than most economies in the region, which after the global financial crisis, they learned their lesson and became quite prudent and did a very good job in terms of macroeconomic management, avoiding excessive debt and also making debt more based on domestic currency bonds, making less susceptible to kind of outflows of hot money that we saw in the previous financial crises. In Sri Lanka, none of that happened, and because they were still being managed poorly economically with these chronic deficits, once you hit the shock of the pandemic, it put a lot of pressure. Sri Lanka was hit by a big negative shock to tourism, which is the sector they were really expecting to produce foreign exchange reserves to deal with some of these balance of payment issues. Then you see the Russian war effect come on, and now suddenly the oil imports are much more expensive than they ever anticipated. Sri Lanka also exports quite a lot of tea, and suddenly markets were cut off. They sell a lot of tea to Russia, and so they were just being hit by these shocks that you could say were unexpected. But they, of course, good macroeconomic management is that you are prepared for the unexpected. You have some prudent management of your risk. So if none of these shocks had occurred, maybe Sri Lanka would have muddled through and would be looking similar today as it did before all of these crises hit. But that's not what happened in the world, and they were unprepared. And I think this is the consequence that we're seeing of persistent poor macroeconomic management.
One very interesting point that you highlighted concerning inflation was that Asia is more rice dependent and less corn, wheat dependent. That's an interesting point. So that has insulated Asia to some extent against food price inflation. And will that continue to be the case?
I don't think we should feel overly confident that rice prices will not be affected by the food insecurity problems that are facing the world. Number one, obviously some countries can shift from expensive wheat to consuming less expensive rice, and that will put pressure on the rice price directly to the extent the two commodities are substitutes. But second, what we're seeing, Russia is a huge producer of fertilizer, and the whole global fertilizer supply chain has been hugely disrupted, and we've seen very large increases in the fertilizer price, and a lot of fertilizer factories around the world just shutting down because they're reliant on these chains that originate in the war-affected areas. High fertilizer prices really threaten to reduce production in many countries, which is going to just put more pressure. And rice is not immune to that either. Rice also, like all crops, use fertilizer to raise yields. And if fertilizer is much more costly or even not even available in some countries, then we could see in the next season or next year it's starting to impact a broader set of commodity prices. So I think we need to still stay vigilant. And of course, there's many other issues related to that are really pressing on food security.
Oh yes, Peter, does it please?
Good afternoon. Pio D'Emilia from Italy, Sky Television. Let me go back to the China issue. The Western world seems to be very concerned about China military and political, well, I wouldn't call it threat, but assertiveness, you say right now, yeah? But economically and financially, what is your personal, I'm not asking the ADB position, of course, but personally, what is your reading of China? Is it a threat or a hope?
Economically, I think I don't view China as a threat. You know, China is a valued, you know, it's a member country of the ADB. They contribute to what ADB does, and we're active in China trying to support them in realizing their development objectives. And the high growth rates in China for the past several decades have really been an engine for growth in the region. So they've contributed very positively, I think, to development throughout the region. I think the current tensions, you know, between Western countries and China on political issues, and you know, has had economic consequences from the U.S.-China trade war to, I think, a concern that a shift in expectations, perhaps, that in the future countries may need to diversify their supply chains away from China to other places. So it has real economic effects, but I think, I mean, I don't think we have I don't think that that's a judgment ourselves that China is a threat or not a threat. I think we would like to see, at the ADB, we are very much supporting global economic integration, free trade, open trade and investment, so that all countries can really maximize the benefits from growth. This has been the formula in Asia, especially the developing countries in Asia. It's been an important part of their growth opportunities in the past, and I think in the future. So we're supportive of frameworks that are inclusive. And I think to do that, you can't view other countries as threats economically. I think we have to really be thinking in terms of win-win opportunities from globalization. And I think, you know, the real actors in the economy have seemed to be, I think, thinking in the same way, to the extent that despite all the talk of reshoring, friendshoring, et cetera, we haven't seen that much evidence that there's been huge shifts. In fact, we've seen very robust trade and very robust investments throughout the region, into the region, but especially within the region, from Asia investing in Asia. And we see that China actually itself has also attracted quite a lot of FDI, including from the United States. So I think that speaks to this power of win-win outcomes from globalization, and not the more zero-sum outlooks that are so often expressed in some of the rhetoric about globalization.
So we're not seeing Asia torn apart by US-China tensions, really. I mean, your point about supply chains is interesting. You seem to be relatively sanguine, you know, that they've not suffered as badly as in other parts of the world. But can this continue? I mean, China and the US are, as I understand it, trying to remodel their supply chains and become more independent. How far will this process go, and won't this mean that the impact on supply chains in the medium, long-term future will be much more profound than it has been so far, or not?
I think the jury is still out to some extent. I think we should also recognize that supply chains themselves have actually been quite resilient during the pandemic. The huge shocks to demand and supply caused by COVID was inevitably going to lead to supply chain issues because no system can respond immediately to such huge changes in supply and demand that were associated with lockdowns in countries and the differences in the timing of lockdowns. But broadly speaking, the supply chains have been very resilient to these shocks. They've kind of bounced back. Of course, they've contributed to inflation and whatnot during the periods that there's been huge imbalances in supply and demand. But I kind of question that, the supply chains weren't working really in a fundamental sense. That said, I think because there have been so many global shocks in quick succession, we've had the U.S.-China trade tension immediately followed by the pandemic, immediately followed by the Russian war in Ukraine, which led to sanctions and kind of unprecedented measures taken to try to isolate Russia, that I think it would be reasonable for both government leaders and for firm CEOs, enterprise CEOs, to think, oh, well, the future world is going to be this very unpredictable terrain where policy measures are going to be used as weapons in politics, because that's what we've seen for the last 5 to 10 years, right? And if that's the world of the future, then I think it would be a sensible response to diversify your supply chains to anticipate the potential vulnerabilities, and I'm sure we'll see some of that. At the same time, the fundamental efficiency logic of supply chains and how much they raise productivity are very powerful forces, including for businesses. So I think you will not see a wholesale restructuring, right? I think you'll just see some diversification. That's my own view. How much? And by the way, I mean, sometimes governments would like to see a big restructuring, but ultimately it's really the decision of businesses that drive the big shifts, right? And so I don't think we should conclude based on, the proclamations of certain officials in certain countries of wanting to see a different world, that is what's going to happen or happen very quickly at all.
Okay. Any more questions from the floor? There is one thing you mentioned, the possibility of financial turmoil in Asia. This is obviously a very sensitive point. Asia has lived through a number of financial crises with devastating effects. If the Fed and other central banks do go on tightening, where do you see the weak points in the financial system globally and in Asia that could cause, the turbulence to become really serious?
Well, our main concern, first I want to reemphasize that I think, broadly speaking, countries in the region are pretty well prepared in terms of the macroeconomic management, less reliance on, short-term dollar-denominated borrowing that is easily going to flow out as soon as sentiment changes just a little bit. But that said, we are very concerned because if growth really slows down quite a lot, and if interest rates continue rising, and by the way, governments, of course, can raise interest rates in response, which also protects them from outflows if that becomes the critical concern. The main issue is about debt sustainability, that if interest rates rise, debts become a bigger burden in terms of repaying those debts. And then if growth slows, then you have less resources also to repay. So you can quickly get into trouble if this persists for a long time. And it's a challenge now because many countries already are at elevated debt levels because they've been borrowing for several years to try to fund really urgent spending priorities in response to the pandemic. And so even when things are well managed, if you just keep getting hit by these shocks, it would put anyone on unsure footing. And the danger is that the most vulnerable ones, or the ones hit hardest, or the ones that were the least prepared, you start to see, as we know, once sentiment shifts and crosses a certain flashover point, then you can see everyone wanting to get out because they just feel like something bad is going to happen, as we've seen in Sri Lanka. And the concern, of course, is that would happen in other countries as the challenges just keep prolonging or becoming more intense. It's always difficult to predict when or if or which countries that would happen to, but broadly speaking, we see these risks as elevating in the low growth scenarios going forward and the high interest scenarios.
Okay, thank you. One more question has come in online, which is again from Ilgin Yorulmaz of Turkish, BBC Turkish. She says inflation in Turkey has increased dramatically recently and now hovers around 80%. Sorry, forgive my smiling. Yet the Turkish central bank is still adamant not to increase interest rates. As Turkey is a member of the Asian Development Bank, what kind of macroeconomic policy do you think can bring the inflation down, if not the interest rate?
I'm not an expert on Turkey, so I hesitate to say too much about what the Turkish. I didn't realize that inflation had reached 80%. So it is surprising to me that there wouldn't be some kind of a monetary response to inflation rates that high. But I guess I should reserve saying anything too specific. I mean, other than just pointing out that what I said before, that central banks are trying to balance competing concerns, both recovery and inflation control, and they need to be thinking about what the causes of the inflation are. But at 80%, it's likely that that level of inflation is being fed to expectations and becoming so would be an issue that needs to be addressed one way or the other, right? That's difficult. That puts a lot of challenges on the economy to have inflation at that rate.
Okay, one final point from me, and that is the ADB has long been promoting regional integration in Asia, and in recent years, events have not been exactly promising from the point. So are you still optimistic that regional integration can go forward, or do you see regional disintegration as a result of stronger sort of exogenous forces?
Oh, no, we are very committed to regional economic integration and bullish on regional economic integration. We have a flagship report that monitors it's Asian Economic Integration Report every year. And what we found in a report that we issued earlier this year is that in recent years, regional economic integration within Asia has strengthened. It's increased, not decreased, during these very challenging years. And we now, of course, this year have the RCEP agreement going into force as of January 1st, the Regional Comprehensive Economic Partnership. And that holds the promise of even more, encouraging even more integration going forward. Of course, there's a lot of implementation issues for the agreement, but its goal really is to make it easier for global value chains to be even more specialized within member countries, and that should promote greater integration going forward. And we think that's good. In particular, more diverse participation in global value chains really can create opportunities for poor countries, because you don't have to be able to produce some sophisticated product. You can just specialize in one part of the process, even if it's simple assembly, to get into the global value chains. And there's research that suggests being part of these global value chains itself carries benefits in terms of helping firms to innovate. So we see productivity growth higher. We've done, we also partner in a biannual global value chain report, joint with the WTO and some other organizations. And that research has suggested that being part of global value chains promotes productivity growth. And also, there's been work by the World Bank and others which shows that being part of global value chains makes you more resilient to shocks like the pandemic. So firms that were part of global value chains recovered more from the pandemic than firms were not, at least some research in Vietnam that I'm aware of. Because if you're a critical part of a value chain, then when something goes wrong, your buyers and sellers really want to support you because they're only as strong as their weakest link. So they help create a kind of resilience for the whole chain. And so we think that's positive, this greater economic integration, and is happening despite all of the global rhetoric about deglobalization.
Interesting point. Okay, well, on that positive note, sorry, we've given you a rather intense grilling, but thank you for responding very promptly and positively to it. So we'd like to thank you for coming. And this is your first visit to the FCCJ. We hope it won't be the last. So to encourage you to come again, we'd like to present you with a one-year honorary membership to the club.
Thank you very much. It's a great pleasure.
Okay, good to see you. Thank you very much. That wraps up the session today. Thank you.